Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site is Dearborn and Brian Joyce, Managing Directors on the Nasdaq Market Intelligence Desk, as well as Todd Walsh, CEO and Chief Technical Analyst at Alpha Cubed Investments. We're here to discuss why long-term investors should stay the course as we remain in a technical bull market. It is great to have all of you with us. Welcome back to Trade Talks. And Todd, it's interesting when you think about advising clients, you usually come with the fundamental perspective in terms of why you should stay invested longer term. From a technical perspective, why do you think it's valuable to incorporate that into your fundamental analysis when you're presenting investment theses to your clients?
Yeah, the first reason is to take the uncertainty out and know when the news matters. We need an objective way to filter out all the different news boomerangs that are coming at us every day and keeping us up all night. Second thing is, when we're in a technical bull market, these last for a year, 2, 3, 4 longer years, so it can inform your trading, your investment management as these news boomerangs come through, and kind of prevent you from being bipolar in your trading activity. And we've been seeing a lot of that with the news kind of shifting the last couple of weeks from one side of the table to the other. We've seen the market, running one direction, then running another direction. We just saw the strong jobs report come and take that 10-year from 3.68 recession territory right up over 4%. And the market is projecting this stuff out into infinity. With our group of retail high net worth investors, we want to take some of the immediacy out of this and think longer term.
Yeah, it's really interesting to see the magnitude of these swings and how what they've typically have taken weeks, perhaps months to play out, are playing out intra-sessions at times, right? Brian, from a technical perspective with the work that you and Todd are doing, are you in agreement that we are in that longer term bull market? Has anything shifted? It feels as if it's staying the course.
No, I'm certainly in agreement with that, and I do like to see what we just came out of in Q3. We saw that rotation, that broadening into mid caps and small caps, financials, cyclicals. So you've heard a lot of commentary. We've spoken about it a lot on this program as well. Really since mid 2023, the market is being driven by a small select group of large cap tech, large cap growth names. In November and December of last year, that changed. We had a big rotation into the broader markets. These rotations recently, in Q4 and here again in Q3, have been driven by that dovish repricing of rates. And so, at some point, I think the baton will maybe be passed on to other groups that may be longer lasting. Utilities have been doing quite well these days. Energy and materials have really been in that 2 or 3 year sideways trading range. Can they be the next leaders in the next part of this cycle? That remains to be seen.
Yeah, and we're going to take a look at those charts in just a moment. But Chris, from your perspective, I think it's safe to say that there will be some volatility, at least through the next couple of months with the election, and then also factoring in economic data has been quite good. Are we going to get as many rate cuts or the magnitude of relative to the 50 basis points we saw?
Right. So when you look back with the 50 basis point cut, that was really more of a catch-up cut. They should have cut in July. And they had plenty of time to look at the data. Again, very data dependent, as they've been saying all along, but they're following right along with the set plot. And really, it's basically looking at 2 more quarter point cuts for November and December. The question is what the inflation data comes out as. Right now, everything's lining up very, very well. You're seeing wage growth. You're seeing jobs being created. The unemployment number ticked down, even though it was on more folks working, coming back to the market. It's still 4.1% is relatively low. Mm-hmm. Probably at some point a year and a half, will probably be north of 4.5, or right around that ballpark, a little bit more normalized there. But the CPI data and PPI this week, even though it's more rent focus as opposed to the PCE, will give us a good idea of what they're looking at. And then, of course, the election is going to be kind of a jump ball to a point. But more importantly, I'm more worried about a couple of other items. One, on the macro side, we talked about China before and what the stimulus package looked like, and how the follow through is going to actually take place with a lot of the larger cap names, especially in the tech space here, that are their business is based out of China. And then what happens, of course, in the Middle East, and then moving over into Europe. So you've got a lot of macro that could take place there, a lot of political shuffling here. I think but all those larger items are going to be more impactful to the market in the very near term than, say, a small blip on the retail data. Because if you look at, if CPI pops a little bit, you're going to have the naysayers on TV saying, you know, we should have cut 3/4 of a point instead of a half. Or, you know, we're going to price in, you know, 4%, a full basis point before December. And if it goes the other way, they're saying, well, maybe inflation is starting to creep up a little bit here. We got to be a little bit more cautious. And so I think they stay the course. They've been given a good hand here. They're holding a royal flush right now off of the employment data that we just had. We need to see if the CPI is going to support.
Yeah, I mean, even when we think about the employment data, Todd, you know, if it moves 0.1%, that's not necessarily going to be a trend make. I mean, when you start to see that tide turn, it's multiple 0.1%. Yeah,
you know, we talked about it earlier off camera. If the Fed's going to be successful and create a soft landing, they've got to thread the needle, and we've been characterizing the data as marginal and mixed. We need to see marginal deceleration, but the market sees marginal deceleration and projects into infinity and gets negative. Then we see mixed data, some positive data, and then we see, you know, the market go in a different direction, and we go from, you know, 2 or 3 cuts before the end of the year to, oh, magically none. We've got to be less bipolar in our analysis of these data-dependent data points that need to actually be, as we call them, marginal and mixed for the Fed to accomplish this, you know, famed soft landing.
You deal with high net worth clients. What do they come to you with? What are they concerned about when they think about the macro backdrop?
100% the election.
Yeah.
Every year we have to do an intervention for a certain percentage of our investors, and we're really getting them focused on not front-running the election. You mentioned a jump ball. Yeah. I think that's a reasonable way to characterize it. Nobody knows who's going to win, so how can you trade that? What you want to do is look at the platform, see what sectors are favored and what's not favored. Probably is not going to be settled that day, the next day, maybe a couple days, maybe a week. Yeah. Get ready for some catalysts for volatility. You mentioned all of them. That's another one, and we are prepared for that volatility. But within the framework of a bullish technical condition, volatility is your friend. Knowledge is power. We know it's a bullish technical condition. How can we get in if it doesn't come down? We need that volatility. Add to your AI hyperscaling names if you're under allocated there, using the outsized volatility to dollar cost average. And you had mentioned the broadening out of the market. Since the Fed paused, we've seen the S&P value index keep up pace in terms of total return, basically with the Nasdaq 100. I call that having your cake and eating it too. We get a much lower valuation, a bigger dividend, sleep at night returns. So that's where we've been focused all year.
Yeah. Brian, let's take a look at the energy charts for a moment here, because of course coming to election, the price of oil is a big talking point. And you've noticed a disparity in terms of the price of oil and how energy stocks are performing. What have you noticed from a technical perspective?
Yeah, I don't want to say there's too large of a difference. So if we're looking here just at the energy sector ETF, XLE, it's the Select Energy Index. It peaked in 2022 and has been consolidating it with a pattern of higher lows into resistance. And the consolidation for crude oil is similar but different. It peaked also in 22, but the consolidation has been lower highs into horizontal support. So how is that going to resolve itself? Because I do expect, given the strong correlation between the two, however one breaks out, the other will follow, vice versa. I did notice that there is a higher correlation, a good correlation between energy stocks and materials, and we are seeing in the last couple of weeks, probably based on the China catalyst, the material sector begin to break out of a wide, almost 3-year trading range. So technically, that would be constructive. Whatever the reason behind it is, potentially could be a false move, but you know, have to wait and see. But you could identify your risk by looking at these levels here. And so my buys, given everything else, given the strong Fed put we've seen since the last FOMC meeting, which I think it was I don't want to call it a game changer, but they in my opinion not just cut rates, but their guidance for 2025 based on the minor changes in where they see unemployment ticking marginally higher, inflation coming down marginally a little bit, but they're bringing down Fed funds in a stronger way. And so the real rate, Fed funds minus core PCE is lower than what they projected from June. It came down 0.6, 0.7. So I think, the Fed put is only stronger based from last SEP to what we just saw in September.
And that's an important distinction to make. And Chris, you spend a good amount of your time with our consumer Nasdaq listed companies. Anything that you can discern from calls that you've had with senior leadership there in terms of strength of the consumer?
It's been quiet the last couple of weeks because everyone's coming to earnings week. So a lot of the companies finally reported the earnings cycle for retail and the consumers is a little bit off. Like you have like Pepsi reported this morning, but then the restaurants and a lot of the retailers won't report till late in the cycle. So what we saw late in the cycle was from a fair amount of mid-tier retail, some very specific ones. And again, they're calling out weakness on the lower income bracket for folks. They're not spending, they're not trading down, they're doing without. You saw that in some of the cyclical, in the consumer staples space as well, coming across here now. But there are the haves and have-nots. Some of the larger ones that we've spoken with are doing very, very well, yet some of the others are not. So again, it depends on where the spend is going. You're seeing a lot of spend on experiences for the most. Still,
yeah.
You still are. But it's not as much as it was prior to the summer. And what was interesting, when you look at the credit card data, revolving debt is kind of slowing down significantly for August, kind of coming well below 9 billion when they're looking for 11.5 or 12 number there. So that's kind of curious that people are spending with that, but I think that goes to the lower income brackets not spending. And you see that a lot in the dollar stores, especially. The dollar stores have been hurting. A lot of those stocks have taken a 65% haircut this year from the beginning of the year to now. So we need to see what Q4 brings to them. And unfortunately, we're not going to get a good look to that till Q1 of next year. So we're hoping for whatever the incremental numbers coming out on spend is really where we need to be. If the lower income bracket starts to spend again, and generally that'll happen with a lower interest rate here, they're going to feel free to spend their money, and wage growth definitely helps that area. You look for some of those areas to rebound, but right now it's very, very cautious still for the majority of the retail names.
That's that marginal deceleration we're talking about.
Yes.
Which is so interesting too, because when you want to think about comps and year-over-year numbers, they're pulling spend by 4 to 8 weeks forward. Prime Day, there's just one in the summer.
Right.
Now there's one October 8th and 9th. So it's almost
go
like
to once a month.
Well, I mean, Amazon's at my house
don't need that
4 or
much
5
toilet
times a
paper.
day.
Yeah.
But if you think about it, the last 6 weeks of the year used to be the benchmark, and now with everything being pulled forward, and by the way, it's not just Amazon. Walmart and other big box retailers do the same thing. So it kind of makes judging the consumer spend a little bit tricky.
I think one of the bigger things we need to be looking at is it's earnings season, newsflash, and we're going to have our set of winners based on earnings estimates going forward and losers, and that's going to help define how we're going to move into the fourth quarter. That's going to take us into the narrative that we're going to have after the election, and we're gearing up for that and looking at it very sort of intensely.
Yeah, all right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me for MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.